Welcome to the Shrimpy YouTube channel, a place where you can learn everything about the disruptive sector of cryptocurrencies and finally start building your blockchain education. In today's video, we will discuss the biggest risk that yield farmers deal with aside from scams: impermanent loss. Yield farming is not as simple as providing liquidity to a decentralized exchange and watching your profits increase over time. In order to avoid losses, farmers have to monitor crypto markets just like any other trader or investor. But how does impermanent loss work, and why is it such a big deal? If you're enjoying this content so far, go ahead and give this video a thumbs up and be sure to hit the red subscribe button to join our online crypto community. Before we explain the importance of yet another complex concept from the world of DeFi, we want to remind you that Shrimpy has got your back in this wild new era of crypto. Mastering DeFi is a new guide written by the Shrimpy team that explains everything that you need to know about decentralized finance. This free ebook covers features like yield farming, flash loans, synthetic crypto assets, and other new products, all while wrapping them in a coherent and intuitive format. If you struggle with finding your way around in DeFi and want to finally understand how it works from top to bottom, our guide is the perfect place to start. You can either download Mastering DeFi at the Shrimpy Academy or find it at the link in our description box below. Impermanent loss refers to the process of temporarily losing funds while providing liquidity to a DeFi platform. Experts often frame it as the opportunity cost between holding an asset as opposed to locking it in a liquidity pool. More often than not, impermanent loss occurs in cases where liquidity pools require an equal ratio of two assets, and one of them suddenly becomes volatile. If the asset's value increases or decreases drastically since the time of the original deposit, farmers will profit less than if they were to simply store it in a wallet and not engage with liquidity pools. To sum it up, yield farmers can expose themselves to risk when providing assets to a liquidity pool. Whether it's that their cryptocurrency of choice lost or gained value while farming, it would have been a much better choice to hold on to the assets instead. Also think of it as a more advanced risk that is found when opening leveraged positions on a futures market. If prices head in the opposite direction of what you had in mind, your position will temporarily be underwater as you start to lose money. If you make the decision to cut your losses by closing the position, your losses will be realized. But if you wait for the market to go back in the other direction, you can close the position at break even and walk away without any losses. It is possible to avoid losses by either joining pools with relatively low volatility or pools with a high yield rate. In the first case, the chance of facing impermanent loss is low since the assets themselves do not gain or lose too much value in a short time frame. By the time you're done with yield farming, your realized losses will either be non-existent or small. The second case, the yield rate can be high enough to offset the losses incurred by impermanent loss. Liquidity pools use exchange fees to distribute rewards to yield farmers. It is possible to profit greatly from a sudden jump in trading volume. Even if you suffer impermanent loss, the money gained from farming will be enough to remain profitable. But keep in mind that determining future volatility is difficult since analyzing market conditions is hard for even the best traders. An asset that usually ranges might be going through an accumulation phase and could rise in value at any point in time. Therefore, it's important to be cautious when yield farming. We also note that impermanent loss is only realized once you stop yield farming. If you expect that an asset is about to retrace from a sudden bounce or dump, you can avoid all losses by only withdrawing your liquidity once prices are back to normal. Certain DeFi platforms are specially designed to minimize impermanent losses. For example, Curve Finance limits its liquidity pool offering to stablecoins and wrapped tokens, both of which hold onto a stable price point. Since there is little to no volatility, it's possible to yield farm without risking any losses. However, yield rates are much lower on these liquidity pools in comparison to ones found on other DeFi platforms. What do you think? Is yield farming riskier than trading in a bull market? Let us know in the comments below, and make sure to like and subscribe to our channel for more crypto content. You can find us on Instagram and Twitter at Shrimpy App and on our blog at blog.shrimpy.io.